Hello and welcome. Before we start, please subscribe to our YouTube channel for the latest news and updates. There was an underlying rotation in the market last week. The Russell 2000 and S&P 500 equal weight outperformed the S&P 500, while the momentum factor traded lower. High beta continued to outperform, benefiting from its semiconductor OW, while low volatility traded lower, signaling a preference for risk assets. Cyclical sectors such as energy, industrials, and materials outperformed, while consumer staples and financials traded lower. Treasury yields finished mostly unchanged after rising earlier, with short and long duration bonds producing similar returns. In the corporate market, IG and HY underperformed as credit spreads widened. Oil posted a modest loss, and the dollar snapped its losing streak to finish stronger. Implied volatility eased, with the VIX and MOVE indices signaling a calmer market. Key takeaways. 1. The U.S. added 147,000 jobs in June, beating the 110,000 consensus. State and local government plus 77,000, and healthcare social assistance plus 58,000 accounted for over half the gains, while manufacturing, professional services, and the federal government cut payrolls. Private sector hiring slowed to 74,000, the lowest since October 2024. Unemployment fell to 4.1%, holding steady in its narrow 4.0% to 4.2% range since May 2024. One factor keeping conditions tight is the participation rate for those aged 55 plus, which fell to a new post-pandemic low. This, along with stricter immigration enforcement, is weighing on labor supply. Implication: the headline beat and falling unemployment reduced the likelihood of a July rate cut. 2. The ISM manufacturing PMI edged up to 49 in June but remained in contraction for a fourth straight month. Production rebounded above 50, but new orders, 46.4, and employment, 45.0, weakened while prices paid stayed high, 69.7. The services PMI returned to expansion with business activity, 54.2, and new orders, 51.3, back above 50. However, like manufacturing, employment fell to 47.2, and prices paid remained elevated at 67.5. Implication: manufacturing and services activity improved in June, but the data suggests tariffs are weighing on factory activity, reducing labor demand, and creating price pressures. 3. Congress passed the administration's Big Beautiful Bill last week, the most sweeping fiscal package since 2017. The bill makes the 2017 cuts permanent, raises the SALT cap, and introduces new tax breaks for tips, overtime, and seniors. It also increases defense and border spending while rolling back clean energy incentives. Nonpartisan analysts estimate the bill will add $3.3 to $3.4 trillion to the national debt over the next decade, setting the stage for increased Treasury issuance. Implication: BBB is a near-term boost to growth, a front-loaded sugar rush, but longer term could weigh on the economy through higher deficits and persistent inflation. 4. The bill raises the debt ceiling by $5 trillion, enabling the Treasury to borrow again. Our U.S. Net Liquidity Indicator, USNLI, in the Quant Pack, P25, shows the debt ceiling's pause on borrowing boosted market liquidity this year, i.e., Treasury spent money but didn't raise new money. Now it needs to borrow $450 billion in the next few months to rebuild its cash balance. Secretary Bessent plans to issue mostly Treasury bills, which should limit the near-term liquidity impact due to the $7 trillion in money market funds. Longer term, the market will need to absorb the increased Treasury issuance, potentially draining liquidity from bank reserves and the stock market. Implication: raising new debt pulls liquidity from the financial system, can reduce demand for risk assets like stocks, and push yields higher, creating a headwind for equity markets. 5. Q2 earnings season starts next week. Analysts cut estimates in Q2, with the S&P 500's EPS estimate falling over 4% since March 31st, figure 5. Earnings are forecast to grow plus 5% YY, down from Q1's plus 113.3% and the slowest since Q4 2023. Key themes to watch include how companies are responding to tariffs, the impact of a weak USD, and whether AI companies will continue to power earnings growth at the index level. Stay calm, stay invested, and let us know if we can help. Visit MRAadvisory.com to learn more and schedule a conversation with one of our advisors. Thank you for listening. For additional information, please visit our website